Right now, with mortgage rates as high as they are, it's making it really hard for buyers to purchase a home, and especially first-time buyers. But in this video, we're going to go through ways for you to get the rate down and keep it down with our good friend, Brent Starks from Unitas Lending. Brent's going to go over these different mortgage programs and how they can help you now with these big incentives that builders are offering and the seller credits that sellers are offering, and then down the road be able to buy down that rate again and keep that payment where it's comfortable. So don't go anywhere. Hi, my friends. If this is the first time you've been to my site, my name is Lee Brickey, and on this channel, we talk everything real estate in Palm Beach County and the Treasure Coast. So if any of that interests you, you're going to want to subscribe. So please slap that subscribe button, ring that notification bell so you don't miss any of our real estate tips and tours. And with that said, let's talk to our good friend, Brent. Hey, Brent, thanks for joining me today. I really appreciate it. This is a really important subject right now because I think timing on purchasing a home right now is really critical with all of these incentives and the ability for buyers to get these credits from sellers. If you're not buying new construction, a majority of homes right now are being sold with a credit. If you're buying new construction, there are huge incentives, anywhere between $30,000 and $60,000. We're seeing some places even higher than that if it's 55 and over community. So, but with these incentives, that doesn't mean that the market's not still moving, because these builders are keeping the market moving. As I told you last week, we sold a home in PJ Verano. Matter of fact, we closed on two of them last week, and one of them, they spent $850,000, had a pool, and did some really beautiful upgrades. And that home took 11 months to build, and 11 months later, it appraised at 1.1 million. And we're seeing appraisals come in low. So seeing an appraisal come in that high was crazy. And the other one was a smaller home. They didn't do near the upgrades, but still ended up having almost $200,000 with equity in that home and closing after the 11-month build cycle. So the market's moving. It's moving in Palm Beach County. It's moving in Martin County. It's moving in Port St. Lucie. Martin County is like St. Lucie County. The market is really up. As a matter of fact, article just came out and said it's the fourth fastest growing real estate market in the United States right now. So, you know, we're seeing people continue to move into South Florida and continue to need housing. And we're also seeing a lot of people moving from down south needing housing. So before we get into talking rates and so forth, let's talk about the benefits of home ownership and why someone should be moving towards home ownership, because a lot of first-time buyers are feeling a little left out right now, because another thing that's happening is almost 40% of all purchases right now are cash. So we're seeing a lot of cash coming back in the market from folks selling their homes in different markets and coming into lower price markets and buying cash. So let's talk a little bit about the importance of home ownership. Before we get started, just to bring up a graph real quick, you know, we talked about Barry Habib on last month's video together, and how from 1942 to 2022, there's really been only 6 times where the real estate market has actually gone down.
All right.
So, and you put a great graph together on this. So let's talk into that a little bit on this rent versus the buy situation.
Absolutely, Lee. I'm glad you brought that up. You know, I bought my first home when I was 22 years old. I think I paid $44,500 for it, and now it's worth $450,000. And so many of us can talk to our parents, our grandparents, and hear similar stories. And it's not really. It's just, this is just inflation is just a part of our natural part of our economy and how things work right now. And certainly it's expected to continue. It's always been in something in place in economics, and there's no reason to see that it won't continue. But yeah, I put together this graph where we can see over a 9-year period, you can start to see what the benefits of home ownership versus renting. It's no accident. The average net worth of a renter is $8,000, and the average net worth of a homeowner is well over $300,000. And most of that, of course, is in the equity of their home. And so we're going to look at this graph and kind of show you exactly why that's the case over time. And what I think I use some pretty conservative estimates as far as the variables, Lee. It was a $414,350 purchase price in St. Lucie County there. And then in the first year, taking all things in consideration, we looked at appreciation, for example, and we put 3.95% as the average increase as far as what we can expect over as far as appreciation, and that's pretty much an average over any 20-year period. You name the 20-year period, and that's what you're going to see. And then we looked at the amortization gain. So in other words, part of your payment's interest, part of it's principal, right? Over that 9-year period, you're going to have $60,000 in principal reduction. So that's one of the things we look at. And then as far as cash flow difference, we look at like, hey, when does the rental payment get higher than the mortgage payment? And that's just a cash flow gain, and we're looking at that. We look at the purchasing closing costs. So that was, included in this calculation. And we looked at the tax benefits, standard deduction over, a 22% tax bracket. We looked at the cost to sell, assuming you're going to sell in 9 years. So we even took that in. So it's assuming you're actually going to sell it and has a cost. And after taking in all of these factors, in the first year, if you look at that graph, you see where it's a $14,000 expense. It's a greater expense to own a home, taking all things into consideration versus renting, right? So when you look at the second year, you're already in a positive. A lot of it, that of course, is because appreciation. This third year, you're up $27,000 and so on. And after 9 years, you're at $247,407, taking all of those things into consideration: the cost to purchase, the closing cost to buy, and the closing cost to sell. And taking all those into consideration, you're almost $250,000 to the good, just over any that 9-year period. And we can put this calculation together, for any variables. If somebody wants to call us and say, hey, I want to put an appreciation at 3% or 10%, whatever they want to do, and I want a 4-year, timeline, I'm planning to get, promoted and leave or something like that. And we can actually show them in very precise ways using their assumptions where we'd be. But clearly, it's pretty graphic here as far as the benefits of home ownership.
Right. And that's one thing that you do great is the anybody can call you up and talk to you about a plan to buy a plan to buy a home. Even if they're not ready to purchase right now, it's something that you do a great job of really
Thank you.
setting people up, give them a plan and let them start working that plan. Because right now we have a ton of new home buyers out there, first time buyers that really want to purchase a home and just don't know how to do it. So right now I've been calling those folks up, and we had a girl call the other day. She's a nurse, and she's like, I know it's not a good time to buy. And I said, well, that's not necessarily true if you're willing to go to Port St. Lucie. And she lives in West Palm and works in West Palm, but she's willing to make that drive to Port St. Lucie to buy a house under $400,000 new construction with these incentives, and then also have her closing costs paid and be able to buy the rate down massively, because right now Mattamy got some huge incentives, and so does Pulte. So homeownership helps you build wealth, and especially for folks that can purchase something right now. Maybe it doesn't fit that criteria exactly what you want, but it might run into a good rental property down the road. You live in it for 3 or 4 years, equity goes up, take the equity out of that house, go and refinance it and buy another home with it. But let's talk about a solution now, because these incentives aren't going to last forever. And as soon as rates start to fall, we're going to see more and more buyers get in. NAR put an article out that says for every 1 point that rates come down, you're seeing 5 million more buyers in the market. So 2 rate cuts 2 points, which would put us at 5.5, would put 10 million people back in the market. So
Mhm.
talk a little bit about like how a buyer could buy right now and
Mhm.
buy down the rate low enough to an affordable payment for the
Mhm.
buyer, and then when that buy down goes away, how we can keep that rate low.
Right. I'll tell you what, it's all about solutions, right? And anytime there's a challenge, there's always a solution in there. It's like, where is something else going to give? And in this instance, Lee, you bring up a great point. It's the seller concessions, right? The seller credits and the builder incentives. And so we're going to let the market work for us, and then we know that certain things are in place as far as rate cuts coming up in the very near future, 18 to 24 months. I think we're going to be in a very different interest rate environment. And having said that, what's being offered in the marketplace right now is these builder incentives and the seller credits. So let's use that to our advantage to get that temporary buy down, and then get to that. It's like playing golf. The first swing gets you on the green, the second one puts it in the hole.
Right.
But how can we get close to where we're headed? So yeah, I'd like to pull up a graph on a 3-2-1 buy down, Lee. And this
Okay.
is actually a scenario that we did for someone just a couple nights ago, and this is basically is an FHA loan. So this is a very low down payment type scenario, $500,000 purchase in St. Lucie County. And so, these numbers are pretty accurate as far as, everyone has different taxes. Every home's different if it's a resale. Of course, the builders, they're on the old, the lot only, and it goes up when they reassess it and all that. But this gives you a really good idea of what you can expect on a $500,000 purchase. And a 3-2-1 buy down, it's basically, think of it this year, the first year, and let's say the market rate of a mortgage is 6.625. Okay. So
Okay.
we're assuming 6.625 on that $500,000 purchase. You're putting 3.5% down, and we're going with a 30-year loan. I put in $10,000 to cover the annual taxes and insurance. Okay.
Okay.
So that's in there as well. But then there's a monthly payment. So the monthly payment would be $39.22. And so on a 3-2-1 buy down, it's like, hey, that might not be affordable, but let's look at a way of taking that incentive and getting that rate and that payment much lower. So, and what they do is they basically look at what would the payment be at a rate 3% below the market rate, or 3.625 as opposed to 6.625. So if you get on that where it says the 3-2-1 buy down, we'll go across the top there. In year one, your rate is 3.625. Okay. The note rate is still the 6.625. So you're at 39.22 and 83 cents. The buy down payment is $3,033. So it's a savings of $889 per month as far as, in the first 12 months. Now, the cost of that is the difference. So you multiply 889 times the 12 months to artificially essentially buy that rate down is $10,668, right? So that's what you're saving year one. Year two, the rate goes to 4.625 for the payment. If you go across the second line there, it's $608.78. Savings per month as far as the payment times 12 months, that's $7,305. So now you've got the $10,668, the $7,305 that has been bought down, by the way, with the seller concessions, with the buyer incentives from the builders. Year three, you've got a rate of 5.625. Again, the 39.22 is the full note rate payment. The savings would be $311 per month at that lower rate of 5.625. At 12 months, a cost of $37.43. So the total cost to buy this rate down, which the builder or the seller can pay for in the form of incentives or seller credits, would be $21,717. And as far as a percentage, FHA allows 6% of the sales price to be used towards seller concessions, and we're at 4.343. So this would work. These numbers would work for an FHA loan with 3.5% down, right? And
Right.
and you're allowed a 6% concession. You're also just on conventional. So somebody says, "Hey, I want a conventional loan." If you put 10% down, you can also use a full 6% is towards concessions, towards buying the rate down, and you have money left over to still help with your title insurance, closing fees, underwriting, any lender fees, things like that, to help cover those costs. So legitimately, at basically a 3.5% down payment, you're in a much lower payment, something more affordable, and you can step into that payment, step into home ownership, as opposed to that payment shock of going into the higher rate environment right now.
Right. And then the plan is, as rates come down, you can save more money. Plus, you're going to have equity coming from the home. You can
Right.
save more money, add that to your equity, and then down the
Mm-hmm.
road, let's say year two, right? What happens? I'm
Yeah.
gonna refinance this because rates are at 5.25, 5.5. But if when just correct me if I'm wrong, when I refinance my home, banks are now competing for that loan a little harder than they would normally. So the rate's going to be a little less than it would on the first purchase, also, correct?
Great point. Great point. Yes, because you've built equity, right? If, let's say, assume that 4%, 3.95% in our graph, you want to scroll back to go through that again, you're going to see that the home going up 4% a year, that's going to be a safer bet, 3 or 4 years from now, right? Because they built
Right.
equity. There's more skin in the game. The borrower has more to lose. They're not walking away from that loan or the property. And so
Right.
that's why those loans are in higher demand. Absolutely. And so, and having the market work for us, as far as not, that's concerned, not working against us, we can actually get that payment that's affordable, build that equity, and then when rates naturally fall into the mid fives, let's say, we can refinance at any time during this period, this 3 or 4 year period, where we can grab a lower rate when the opportunity presents itself.
And then they can actually buy it back down to where they need it to be in a
Right.
straight buy down.
That's
And what
exactly
would
right.
that cost them to buy it down a point?
Yeah, you're looking at, it's a loan this size, $7,000-8,000 that you can roll into the closing costs.
Okay.
So let's say rates get down to 5.5. Right
Right.
now, you're looking, if you can get the high fours, the loan this size, somewhere in the $5,000 to $7,000 range, and it changes every day. That's not something I could pull up and show you right now, because it does
Okay.
change all the time. It's there's sweet spots on the rate sheet. Sometimes a higher rate actually costs less, or costs more to get. It's bizarre. There's sweet spots on the rate sheet that we help people. We in full transparency, we actually let them pick their interest rate, and they can actually see what I'm talking about. But yeah, there's going to be an opportunity, certainly within the next 24 months, to refinance, and then grab that rate. And then if it's a home you're planning to stay in, I just tell people, if you're going to buy the rate down permanently, the break even on that's about 6 or 7 years, where after that point, the cost to buy it down has more than paid for itself, and then you're in the money that point forward. So historically, anything with a 4 in it is an incredibly low interest rate if you look at the last 70 years. And
Right.
so that's something to keep in mind. The 3% stuff that was going on, several years ago with COVID, that was kind of a one-off. That's never
Right.
really happened. Interest rates were
Right.
basically zero. The Fed was, lending money at zero.
Correct. Correct. We're
Yeah.
not getting back to that. And
No.
then what happens? So, and again, another thing, just correct me if I'm wrong, and you can expand on this, but if there's a year left, and let's say there's a year left and they've got that $3,700 sitting there, they're going to get that money back when they refinance, correct?
That's exactly right. You never lose the concession. You have a full, you'll get the whole thing, so there's no concern there. It's basically reflected in the payoff. So that credit, if you will, is always sitting on that loan. And when the loan is paid off, that payoff demand would reflect that $3,743.52, right? So
Right.
so yeah, you're never losing it. So if the market presents an opportunity in 18 months, it's not like you're walking away from all that benefit. You still get it all in the payoff.
Right.
Yeah.
So your advice to someone purchasing right now is take one of these buy downs and not buy the rate down completely, because to get it as low as these buy downs would cost $50,000.
Right.
Where
You're
with
looking
these 3-1 buy downs, 2-1 buy downs, you can buy it down as far as you need to get it, and then take that money that you would have spent on that buy down and use it down the road when rates are actually lower.
Absolutely. Let the market work for you, not against you. You're basically taking something the market's giving us right now is seller concessions. They're available. Let them buy the rate down, and then when the market presents the opportunity, you grab it. So
Right. And that's why these builders, just so everybody knows, that's why they're doing these concessions. They're doing it to move houses. And
right.
especially in these new communities like PJ Verano community's been around for a long time. It's an age targeted community. Homes are beautiful. There's no spec homes in there. You're not getting a deal in there. You're not getting, I think right now they got a $17,000 incentive towards upgrades. So,
Mhm.
there's no incentive for closing costs or anything. Where you're finding those incentives are in new communities that have just gotten off the ground, that are establishing themselves, and even like Cadence, which has done very very well in Port St. Lucie. They're still got incentive. They've done some of these houses that are sitting that have not been purchased. These specs that are ready, they've got really nice incentives on those too. You've been seeing that
Mhm.
$20,000-$30,000 incentives sometimes on those. Just not
Mhm.
as many incentives in the newer communities like a Kinley or a Seville. So so
And
that
the nuances, Lee. The nuances, like, because I hear from people, the
Well,
buyers
even in
that
West
work there,
Palm
they
Beach, I
say, yeah,
mean, you go out to Westlake, they've got
yeah,
huge incentives out there. I don't do a lot of
yeah.
business out there because it's an hour drive for me, but
Right, right.
but if you want to live in Westlake, you want to live in any of these new communities, and then when you get up in these $1 million homes, I mean, they've got pools and screen enclosures and $100,000, $200,000 incentives. I mean, it's all out there for people to
Mhm.
jump on.
Right.
Again, reach out to Brent for anything. Brent, thanks for joining me today, and we'll see you in the next call. Okay, man?
Sounds great.
All right, brother. Take care. So I hope you liked this video. If you did, please like this video and give me a thumbs up. I really appreciate it. It lets me know I'm making the right kind of content that helps you folks navigate this ever-changing real estate market right now in Palm Beach County and the Treasure Coast. And also, if you have not subscribed, don't forget to slap that subscribe button right there, ring that notification bell so you don't miss any of our real estate tips and tours. And you can find out more about the new construction market and what's going on out there right there. Be kind to each other, and I'll see you in the next video.